What's up, everyone? It's Karthik with MoneyVest. So we got to get ready for next week. And of course, for Monday, we do have inflation numbers coming out next week. And Tom Lee also mentioned the worst of the selling pressure is behind us. So he also talks a little bit about the VIX terms futures, which we have also discussed on the channel. It was kind of interesting for him to kind of reference that because we've been talking about it all week last week and how we had a very, very significant shift because we went into backwardation for VIX terms futures. And now we're starting to move back into contango, especially the back half of the VIX futures are in contango. The first few contracts are still in backwardation, which we are most likely going to switch back as volatility continues to come down. So he did talk about volatility, as you can see. The VIX is on the screen. He also talked a little bit about the jobless claims numbers, and I've got a lot of data that I need to break down. I've also broken down the seasonality trends for all of you. I spent a lot of time on this, calculating seasonality for the S&P 500 going back as far as 1900, so over 100 years worth of analysis on seasonality. So if you appreciate this type of data-driven breakdowns on the markets, please make sure that you drop a like and subscribe to the channel, and also do me a favor and share these videos with other investors and traders, market participants, family, friends, whoever you can find, pretty much anybody on street. If you want to share this video, please do that. That's what helps our channel grow, and of course get more people involved in our discussions and engagement, and of course join our Discord if you want to. There is a 16% annual discount available until the end of this month. So starting first with the economics calendar, let's just come over to what is coming up next week. We do have the federal budget balance coming out on Monday. We do have core PPI and PPI. So those are very, very important inflation numbers, PPI and the CPI, that are coming out next week. So big week. I did a video earlier on CPI breaking down that data, so make sure that you do check that out. But PPI, core PPI expectations of 0.2% and month-over-month headline PPI of 0.2%. And then, of course, the big day is going to be Wednesday, August 14th, is when we have the CPI numbers coming out. Expectations are for headline at 3%, core at 3.2%. That's on a year-over-year basis, and for month-over-month core, 0.2%, and headline also 0.2%. So again, make sure that you do check out the previous video that I posted breaking down the entire inflation numbers. This right here, again, continuing jobless claims on a Thursday as they come out every single week. We got retail sales, Michigan consumer sentiment surveys, we got housing starts, inflation expectations, and a few other FOMC members also talking next week. So it is going to be pretty packed, more specifically inflation, for which I will be live. And we do also have the Atlanta Fed GDP numbers coming out for the third quarter as well. So this right here was the video that I was referencing earlier, and he did talk about the VIX terms futures, and you'll notice that this is the current structure for volatility futures, as the first contract expiring in August, right? So August 15th actually is when it's going to expire, or maybe another 11 days. So August 22nd, that's the third Wednesday of the month of August. We are still priced higher than the contract expiring in September. So that is a backwardation because the shorter term contract has a higher price for volatility compared to a contract that expiring a little bit further out. But of course, volatility is expected to spike in October and then of course come back down. And then we are in contango post December, it feels like. So this is going to be August, September, October, November, December, still in backwardation, and then post December we are back in contango. As the farther we go out, the options are priced higher. So really what we're looking for this market stabilization is for this contango level from negative to turn back into positive, meaning that the most near-term futures is now priced below the September contract, and that's exactly what we want to see, and that's what was referenced in that video from Tom Lee as well. Now, in terms of earnings, we also do have a few companies, like Monday is reporting on Monday before the markets open. By the way, you can find this calendar on our entire MoneyVest platform, so that's going to be available for all the members. Link's going to be down below if you want to join. We do have companies like Home Depot, we got C Limited, then we've also got Target reporting, so it's going to be a pretty big retail week as well, because we have retail sales as well as some big retailers reporting like Target, Walmart, Alibaba, John Deere, Applied Materials, then we got Grab, we got Ross, and then that is it. Cisco is reporting, so those are going to be some very important companies reporting next week. So inflation and earnings still on schedule for next week here. Now, coming over to some of the data. Actually, before we get further into the seasonality data, I really want to break down some of the other things with respect to the market. So this again was the VIX futures term structure. This is the current streak for the market, which we have discussed. So we are now 2 days into the markets being green. So we are currently over here. So this is where we are, 2 days win streak, which we have seen over 1,700 times, 1,750 instances, or 25.6% for the markets to see 2 consecutive days in green. The lower we go down in this sort of analysis, the lower the probability will be for those marginal upsides, meaning that if Monday is green, now we move into 3 days. If Tuesday is green, we move into 4 days or 5 days or 6 days. As those streaks continue, the market, of course, is going to go down in this sort of analysis because we've seen fewer and fewer streaks for consecutive green days. So the probability for us to keep seeing green diminishes as we continue to move higher and see those consecutive green days. Hope that makes sense. I covered this in a lot more detail in my previous video as well. So this again is where we are within a context of a pullback. So within 10% from all-time highs, you can actually see that in our market snapshot. So if you come over here, again, it'll give you a bit of a sense of where we are with the market. So S&P 500 still within 6% of its all-time highs. The NASDAQ is still a little bit over 10% from its all-time highs, so still within a correction. S&P is in a pullback, and the Dow Jones is down over 4.6%, so still within a dip for at the moment as well from its all-time highs. Now coming back over to this, so this is volatility. So right now we're at 20.37 as we discussed in our previous videos as well. So we've moved back into a normal zone in the 63rd percentile. We were, of course, last Monday, a complete state of panic and fear as the volatility spiked over 65, and we immediately went over to 99 percentile. So we were extremely high, but now we have moved back lower to 50 to 75 percentile levels, which again are incredibly reasonable to low readings for volatility. So that buy window was incredibly small, and we have now moved down significantly on these percentiles. So as the volatility, if indeed it spikes again, there's going to be buying opportunities for us. Once again, we're going to be keeping a close eye on both volatility as well as the MoneyVest index for us. Now, one more thing I want to mention is that we do have the deadline coming up for 13F filings, and that again can be a huge catalyst for the market as well. So not only do we have earnings, inflation numbers, retail sales, volatility, but we also have 13F filings. Now, 13F filings are filings that all investment managers and institutional investors managing over $100 million of assets under management have to file with the SEC, and the deadline is August 14th. So that's pretty much Monday, and we're going to learn, and I've kind of gone through this data in the past, most institutional investors, most hedge fund managers, institutionals wait until the last day to report their transactions, right? So if they're making these transactions in the second quarter 2020, actually we're looking at this second quarter 2024. This is where we are. That was 2023. This is 2024. So as they are making all these transactions in the second quarter 2024, buying and selling stocks, they have to report them, and the deadline is August 14th, 2024. So I'm sure there's going to be a lot of market volatility. There's going to be a lot of sentiment for individual stocks all over the place because we have learned over the last several reports, including Berkshire Hathaway's and Warren Buffett's, that there's been some incredible amounts of net selling, including insiders that are also selling their own stock. A lot of investors, a lot of institutional managers may also be doing some net selling in the second quarter, which we'll learn about on August 14th, which is a Wednesday, by the way. So not a Monday, a Wednesday. We're going to learn more about the 13F filings. That's the last day for all these hedge funds to file for the 13F with the SEC. Now, going over to seasonality. Now, I took the liberty to look at all the historical data and essentially calculate for you both the probability of a specific month to be green or red, and also the average return for that particular month. So as I'm sure you would guess, the worst month for the markets is indeed September. This is going back as far as 1900s, this is 1950, this is 1975, and this is since 2000. So we've got an analysis for, well over 120 years, but also 24 years. This is going to be for almost 50 years. This is going to be for 75 years, and this is going to be well over 100 years. And what you'll notice is the best month has always been November and December. So those right there are the 2 months for the market which have been very, very good, not only from a probability standpoint, but also from an average gain standpoint. July has also proven to be very, very good, and what we witnessed in July, so 1.5% since 1900 has been the average gain for that month. Since 1950, it's been 1.29%. Since 1975, it's been just over 1%. And since 2000, we've seen a 1.5% average gain for the month of July with a 68% probability that that month is going to be green. Now, that has increased over the years. So you'll notice that 1950, it was at 60% probability. 1990, it was 61% probability. 1975, it was 54% probability. But more recently, over the last 24 years, July has been a very, very good month for the market, getting up to over 68% probability that it's going to be higher by 1.5%. A few more months that have been really good compared to their past are April and May. I feel like those 2 months are the underdogs, because in the past you'll notice that we only had a 56 to a 64% probability for these 2 months to be higher and green if you compare them to 1900s. And in fact, May was actually a down month, but then it quickly recovered to 28 basis points higher for that particular month since 1950. 1975, we're looking at 82 basis points. Since 2000, it is a little bit lower, but the probability for it to be green is much higher at over 72% for both of these months. April coming in with a 1.66% average gain for that particular month. Since 1975, 1.68%. April just under 1.5%, and 1900s, we're looking at 1.2%. So April has also been a very, very strong month for the market, but April is already behind us. So let's look at what's coming in front of us. So we've got not the best month coming up. That is September, of course. September, every single time series that you look at since 1900, since 1950, since 1975, and more recently since 2000, it's only gotten worse because September, we have seen an average loss of 1.65%. This is perhaps the only month for the market that has historically been really, really bad across all time series, because you'll notice that since 1975, August has been fluctuating a little bit. So it's been up since 1900s on average. Then since 1950s, it's been lower. 1975, it's back up again. And since 2000, it is back down. But no other month has fluctuated at all. Like September is the only month which is consistent to the downside every single time series that we look at, and the probability is really bad. And it's only gotten worse because since 1900s, it was a bit of a coin flip. Since 1950s, we are 43% higher. And since 1975, we're 42% higher. And since 2000, we're only 46% higher. So probability is low. In other words, 55% probability that we're going to be down in the month of September by an average of over 1.65%. However, if you do take advantage of those opportunities in September and the markets are selling off and we actually buy during that month, November, December tends to be incredibly positive. Since 2000, November has been the best month. Makes sense because it's my birthday month. And 1975, 73% probability for us to see over a 2% average gain. That is a very, very strong result for the month of November for the markets. And since December, also a 2% average monthly gain with a 75% probability that we're going to be higher. That's the highest probability that I was able to find on this entire seasonality chart, meaning September, since 2000, September having the worst results, down over 1.65% on average with a 45% probability for us to be green, meaning 55% probability that we're down, and November being the best month, 75% probability that we're higher and up by on average over 2%. So this gives you a bit of an idea, on where the seasonality stands for S&P 500 going into September, October, November, and December. If you do continue to see some more pullbacks and some more corrections in September because of its seasonality, then I am going to be ready to take advantage of that and, of course, buy and dollar cost average during those market pullbacks and those corrections. Of course, kind of tying all that in with volatility analysis and the MoneyVest index as well. Coming over to S&P 500 for the upcoming week, as we have already discussed, that there are going to be some very, very important levels to watch for the market. So if you come over to SPY over here, you'll notice that this is the overall uptrending channel for S&P 500. As you can see, that we are consistently making higher highs and higher lows. We came down to that support of this higher low inside this uptrend, and the RSI, the MACD, also incredibly oversold at the moment. So a technical rebound is possible. However, we do also need to keep in mind some of those moving averages that we're going to be coming up to. For example, the 21 EMA and even, I believe, the few other moving averages such as the 100 simple moving average, or that's the 50 simple moving average. That's also, we're trading below that 100 SMA. As you can see that we broke down below that level. We're going to be coming back up to that resistance. So it's going to be quite interesting whether S&P breaks out above that level or if it gets rejected and, of course, gets sold off fairly quickly once again. But either way, I think this was a nice little correction for the S&P 500, a very healthy correction, something that we did need from the markets, despite the reasons of being a carry trade from Japan, recession fears over in the US, unemployment accelerating higher. Whatever the case might be, this was a lot of short-term weakness that I think investors needed to take advantage of. And if you do sell off further, which again, nobody really has the answer to whether we're done selling off or not, but if we do, we're going to be ready to take advantage of that market volatility. And I broke down a lot of other analysis with respect to the liquidity frameworks, how much cash that I personally hold in my brokerages, how many months of expenses that I actually hold in my savings, what's the plan, my entire playbook I broke down in my other market updates. So make sure that you do check out those videos. I'm sure those are going to be very, very helpful for all of you. So that's where we are. Oversold on the markets here. Nice little technical bounce possibilities going into next week, but inflation numbers are going to be very, very important, and that's really what's going to dictate whether we see more upside or not. Same thing with the NASDAQ. In fact, it came down to a very nice higher low. As you can see that it bounced right off of that support here, oversold RSI and MACD as well. So there is opportunities for us to see a bit of a technical rebound considering how oversold we are on the daily time frame. So going into next week, I'm not a betting man, but I am going into next week a little bit more on the bullish side, considering that the technicals do look oversold and there is possibility for volatility to get crushed down further as we move back into contango and for the markets to push higher a little bit. But either way, I'm going to be ready for more selling pressure with deploying my dry powder. And for September, of course, seasonality wise, I'm going to be even more ready and more prepared for if the markets do give us those opportunities. So hope you all enjoy this video and a complete update on the markets. Hope you are ready for yet another week in the markets, and it's going to be quite an interesting one. Let me know in the comment section down below if you have any questions, and join our Discord with that 16% annual discount. Share this video with your family and friends and other investors and traders. As always, happy investing. I'll see you all in the next video.